Shine. Join us for a discussion with portfolio managers, Mr. Kenneth Tang, Senior Portfolio Manager, Nikko Asset Management. Mr. Terence Wong, CEO and Executive Director, Azure Capital. Moderating this session will be Mr. Yo Wei Ren, Manager, Stocks and ETFs Research, IFA Singapore.
And thank you to everyone for joining us here today at What and Where to Invest 2021. And today, for today's panel discussion, we are going to talk about something that is close to all of our hearts. We're going to talk about our home market, and that's Singapore. So Singapore's equity market is in quite an interesting spot. Its performance hasn't been as well as its other global peers. And not just in 2020, but we have also seen that in the past few years as well. And I think 2019 was a very good example. It was supposed to be a good year for equity markets in general, but Singapore's equity market has surprisingly been lagging behind its global peers. So I'd like to start off my panel discussion today by talking a little bit about Singapore's historical performance. And my first question to our panelists today is, Kenneth, Terence, what do you think are some of the key reasons why the Straits Times Index has underperformed its global peers for the past few years? And maybe I'll first invite Kenneth to take this question.
Well, thank you, Wei Ren. I think it's a great question to start this webinar. One wise investor once said that in order to know the future, you have to understand your past. So let's start with understanding why Singapore gave you a return of minus 8 to 9% last year, when every global market or generally returned something in the region of 16 to 17%. And when you look at Singapore's reason for underperformance, I would like to just highlight a couple of reasons why Singapore underperformed. The first is really Singapore is a value market. And as you can see in the chart above us, you can actually see that return on equities for Singapore has actually been on the downtrend for the last 10 years. And with lower return on equity, typically that's really a signal of obviously weaker economic performance and weaker corporate earnings performance. And that has actually led to the derating of Singapore in many regards. The second reason why Singapore would have underperformed last year is actually its demography. And we all know that the Singapore market is actually quite well concentrated in banks, property and telecommunications, which makes up almost 70 to 80% of the market. And last year wasn't a very good year for financials, given the focus away from value and into growth. So when you compare Singapore with the other markets, such as Asia and the global markets, you will find that there's actually a very different sector demography that has actually led to reasons why Singapore has underperformed.
I think if you look at the general composition of STI, just to take it a little bit further from Kenneth, it's almost 50 to 60% of it, they're dividend yielding companies. There's like the banks,
Yes.
like you mentioned, the telcos, and
REITs.
of course, who can forget the REITs,
That's right.
And then when SPH got booted out in June, the next 5 on the reserve list, they're all REITs. Everybody was lapping onto the REIT story, the dividend story, and we're heavily concentrated on that part. But it's not to say that our markets didn't perform, because there are many companies, like say the glove makers, for example. They're up like 6 times, 8 times. We're not talking 6 to 8%, we're talking 6 to 8 times. But they are not part of the STI, unfortunately, right? And some of the smaller tech companies, the manufacturers, they're also up like 30, 50, 60%. But again, they're not being represented on the STI.
So it seems like the STI is like what Kenneth has mentioned just now. It is, a lot of them are value stocks. But in the past few months, actually with positive developments on the vaccine and also Singapore's economy opening up, value stocks have actually started to gain traction. And this has been reflected in the performance of the Straits Times Index. So I think my next question to you guys is, do you think this rally can sustain itself, or is it just a false dawn? Maybe Kenneth, you'd like to take it away?
I think again, when you look at with the perspective of of history, you can understand then what it takes for Singapore to perform is for value to come back and for returns to improve. And I think the report card is quite good. When you look at the broader economy, we are actually on the road to recovery. Just a general chart that shows basically some indicators on transportation movements, as well as retail activity, we are quite close to what we call normalization. And that is actually a good verdict for Singapore coming out from the economy downturn that we saw last year. And if that continues, I believe that will actually set the scene for the markets to perform better.
Terence,
I
you also
actually
think?
agree. I
Yeah.
totally agree with Kenneth. You look at the economy for this year. In fact, for the first time in the past decade, Singapore is actually going to outperform. In fact, be one of the best in the region at over 5%. So very, very happy, and I believe that is going to drive the markets. Of course, if you're saying whether this rally will just like go all the way like to June, December, very unlikely. Of course, there are certain things there are certain humps along the way. And don't forget, if you look at just Singapore alone, we are still about 20% away from our all-time peak set in October 2007. That time was over 3,900 points. We're a distance away, whereas a lot of the other indices globally have already hit their all-time highs. And like say US, for example, NASDAQ, S&P, they hit record after record. And the propensity for them to falter is there. And if they were to do so, there could be, some short-term kind of like we fall in sympathy together with them. But I think if you are looking at the longer-term picture, like for this year, there's really a lot to be optimistic about.
I think I just want to add and just affirm what Terence has just said. I mean, when you look at really relative valuations, Singapore is cheap. And we all know this, but this is just, again, an example of how much Singapore has lagged the region. And we do feel that as the global economy starts to reverse more positively, our value is going to come back in terms of performance, and that could actually help Singapore do better. So we actually are quite optimistic for the prospect for Singapore in 2021.
But whether or not value stocks can actually perform in 2021 will very be dependent on whether Singapore's economy can actually recover in 2021. So actually at this point, I just want to take a step back from this discussion on equity markets to look at Singapore's economic outlook, because Singapore is an export-oriented economy, and a lot of our economic activities, we're dependent on external demand. So maybe Terence, my question to you then is, what do you think is the global outlook, economic outlook for 2021, and what does this imply for Singapore's economy this year?
Well, I don't really have to be economist to answer this question, even though I study economics. Not a great student, but I study economics. But you see, like last year was so terrible, right? That this year is bound to be better than last year. And last year, most of the countries like globally were locked down in the second quarter. We've seen like quarter and quarter improvements, but on a year-on-year basis, I'm quite sure that we're going to do decently well. And Singapore being a small open economy, we are going to be a beneficiary of this improvement in global economy. Like I mentioned just now, Singapore, we are likely, because we are a small open economy also, we are likely going to outperform the rest of the region. So this year should be a good year for us.
Kenneth, is that also a view that you
I
hold?
agree with Terence. When you really look at the fabric of Singapore's economy, exports account for close to about 200% of GDP. So we are very much an export-oriented economy. And one of the things that maybe investors have not paid as much attention to is, despite last year's COVID impact on the economy, the one sector that got really hurt very badly was the service sector. The manufacturing sector actually did very well. Again, when I look back at the last 25 years, again, a chart that I could perhaps help illustrate this better, is that whenever you see Singapore exports perform well, typically it's a good harbinger of better returns to come for Singapore. And we saw a very good recovery for Singapore exports actually from last year. And that actually helped to hold up Singapore's economy much better than what people foresaw. And when you look at really the past 5 down cycles, most of that has actually been preempted really by a recovery in exports. I actually find quite interesting that when you look back, I do remember, again, when Terence talks about history, in 2003, there was a very similar pandemic, maybe less serious than today, called SARS. And we actually saw the STI gain significantly after economic exports or electronic exports bottomed and actually performed very well. So in some way, it's a bit deja vu. There are different aspects here again, but I would believe that this is actually another good indicator of equity performance that we can expect in 2021.
Back in 2003, I remember vividly there were a host of contract manufacturers, tech companies. Okay, they're not really tech, but the contract manufacturers that surged up. Many of them like doubled up, grew 150% because interest returned, and there was real business coming through. The orders started to rack up back in 03. I remember that the real turnaround was in the second half after May, when equity market started to rocket. That's when they started to have all these improvements in their orders.
Yeah, but the sad thing is some of these technology companies have been either privatized
Oh yes.
and taken over. And I think that's really true because I do remember 2003 also was a good time for industrial stocks. So it was not just technology companies. I believe there was the JITs, the Jurong Techs, but there was also the broader economy such as the Costco holdings, the Hong Leong Asias, where it was really a good fabric of the industrial economy. And a lot of the industrial stocks have benefited from that period of recovery. So interestingly, this year or last year, we did see a lot better performance. I think the names that Terence mentioned, many of these stocks were actually very strong performers and gave you positive return, even though the STI returned negatively.
But the fact is that if you look at the makeup of the STI, I think no discussion on Singapore's equity market will ever be complete if we don't talk about the biggest stocks that is inside the index, and that is the 3 local banks in Singapore right now. They make up close to about 40% of the STI. So in order for STI to do well, the banks, first and foremost, they have to do well in 2021.
That's right.
So I'd like to now move on into perhaps more sector-specific stuff and talk about the banking sector. And maybe I'll get Terence to come in. So Terence, how do you see the banking sector, the outlook for Singapore in 2021?
Stocks are typically forward-looking, and I think that investors are confident of this year, and therefore they started to play up the bank stocks. That's one of the first, they're the front runners. They've gone up about 10%. I think that there's still some room to grow, given that but they may take a little bit of a breather right now. I'm not too sure whether they're going to outperform the market because, like I said, they are front runners. They've gone up already. A few things that they are actually enjoying. One is the NIMs, I think, have become a lot more stable. And last year there were a lot of provisions being made in the first 9 months, and it may possibly be over providing. So that's another, I think, another point that they actually benefit from. Fee income is also likely going to increase. Currently, I believe the banks are trading 1 to 1.1 times price to book. It's still slightly below the average of about 1.2, 1.3 times.
Terence,
but of course, the thing that I guess people may potentially be worried about is that sometime in the near future, the digital banks will be launching their product, and in Hong Kong is very, very bruising. You can see that some of these digital banks actually come with 6% interest rates just to draw the deposits. But that said, I think that our 3 banks, they are digital banks. They were very forward-looking, and they seem like they have this in the bag. So really, it is for the new debutants, the digital banks, to really up the game.
Terence, I think you mentioned about net interest margins, which is quite an interesting area to focus on. Now, my follow-up question on your answer then will be, with interest rates remaining at such low levels, do you think there is scope for NIMs to rebound meaningfully for the banks this year?
Okay, I don't think that they'll rebound. Kenneth, you probably want to I don't know if it's different, but I don't think it's going to rebound. It's probably going to stick around. But because expectations over the last 2-3 quarters were so low, like I'm saying, it's stabilizing is actually quite a good thing for the banks. Yeah.
Okay.
But for me, even though I think that the banks will do decent, it's not likely to be a sector that I'm going to outperform or they're actually going to be overweight on. Yeah.
Okay. What about you, Kenneth?
Yeah, I would like to chime in. I think 2 things matter a lot for the banking sector. The first is really the credit cycle and how provisions have actually been front-loaded. And I do agree with Terence that we have probably done a lot more prudent way of actually addressing that credit cycle. I think the other thing which I think you touched on really importantly is really the direction of the yield curve. And banks basically make most money from a steepening yield curve. And I think we have seen a little bit of that happen in the last week, and that's really why the banks have performed very well. But to assume a very strong road to recovery where yields steepen and basically get back to levels that they were, I think is going to be quite difficult. I would think that it will probably be more driven for the banks, in my opinion, to be, again, the ways that they can actually deliver growth in a low yield environment. And I think some of the banks that are looking interesting for us are those that have tapped onto, obviously, fee income as a lot more as compared to their traditional lending income. And I think some of the banks have actually done better in the area of wealth management, the way of digitization, and looking at how capital markets have actually benefited them. So that is where I think we could see some performance within the banking sector in the area of the fee income.
I think besides the banking sector, I think another sector that has been affected by COVID this year is actually the REIT sector. And I think for most of our viewers right now, I think for them, if they are an income investors, there's a very good chance that they have S-REITs inside their portfolio. So they'll be very interested to know what is your outlook for S-REITs in 2021. So maybe, Kenneth, I'll get you to share your views first.
Thank you for the question again. I think we have continued to be strong advocates of dividend investing. Dividends is a core part and a core fabric of the Singapore stock market. We have one of the highest dividend yields in the region, as you can see again from the chart behind us. Singapore yields are attractive compared to the regional yields in the various markets. And one of the things that I think is important for dividend investing, especially this year, is really coming back to finding dividend growth. We should not be too focused on the absolute yield, but on companies that are able to deliver dividend growth in a time where probably growth is actually quite scarce. And within the S-REIT environment that you mentioned, I believe there are certain sectors that are still offering you good growth prospects, such as the industrial REITs, the logistics REITs, as well as selective retail REITs, which we think are benefiting from growth recovery from the reopening of the economy. So there are pockets of areas where we think performance can come from the S-REITs, and we actually like these sectors.
Kenneth, you mentioned that logistics and industrials are some of the areas that you are positive on, but I think most of the S-REITs within those sectors, they have actually rallied quite strongly. And I look at REITs like Capital TC REIT, for instance, it has done exceptionally well in 2020. So given that share prices have run up so fast, do you think it is still an opportunity for investors to capitalize on?
I believe some of these REITs have been priced for a lot of the delivery of that growth, but I believe that they have also continued to exhibit really good sustainable opportunities to continue to build on that growth. So some of these companies have been able to make acquisitions to really improve their growth prospects, and there is also greater opportunity because of COVID that will come from consolidation and perhaps more M&A in this sector. So I think these are some of the internal opportunities that we see in S-REITs, where we think that more stock-specific drivers could actually determine better performance. So it's not, again, we are stock pickers. We are not taking a blanket approach in owning sectors for the sake of those propositions, but focusing on really companies that can outperform in this time.
But I think within the S-REITs sector, there are also certain segments that are being impacted by COVID-19. So retail REITs, office REITs, for example, they are being disrupted by COVID-19. So I think I will pose the next question to Terence. So Terence, what do you think about the prospects of office and retail REITs? Is that an area that investors should stay away from, or do you think there are still opportunities within?
Well, I think within the REIT space, right, since so many of you are into REITs right now, there's really the guys that are a little bit more defensive, and then there are those that can ride on the recovery. The industrials will probably fall in that, and a lot of people are lapping onto the industrials, and therefore you can see that the yields have been depressed beyond the average, right? Whereas the rest of them, I think they're still falling within that band, whether you're talking about office or retail. And I think that I agree with Kenneth. I'm not so much into subsector kind of like picking. Last year was very, very intuitive for me. I mean, I think that the retail guys are gonna go. Hospitality is very, very tough, right? And therefore, I think that industrials will be one area to huddle in, like basically be a safe haven. But right now, if if I take the view that things are going to improve, I believe that there will be selective stocks within the two spaces that you mentioned, whether in office or retail. Both, of course, they are hit. I mean, in terms of like the growth prospects, of course, there are headwinds, but then there are still, I think, picks within these two sectors that you can look at, especially those that can, like right above the rest and go back to the normal growth rate where they were in 2018, 2019. If they can surpass that, and look beyond the 2020 harsh numbers, I think these are some of the companies or some of the REITs that you can think of investing in.
I think one of the most interesting, or rather one of the stocks that investors has been buying recently is travel-related stocks, especially with positive news on vaccines. So a couple of travel-related stocks within the STI, they have also rallied as well. Kenneth, maybe could you just share with us your thoughts on this rally, and can travel-related stocks potentially do well in 2021?
Yeah, I think that's an interesting question. When you really look at the service industry, which really encompasses travel, that has been a really sector that has suffered the worst. In fact, last year, when you look at the GDP numbers of close to negative 6%, almost entirely came from the service sector. The manufacturing sector, as I mentioned, was really a positive driver as compared to the service sector. We are in recovery right now, but my view is that I think the service sector will remain challenged because I think normalization for travel will take probably a longer period of time, and for the full resumption of tourism, of travel-related services, we think will actually take a longer period of time. So I'm of the view that service sector is going to be probably a more challenged sector in 2021, and we think that that's going to be the case. That said, when you look at service sector as a whole, it's actually quite interesting when you look at the fabric of Singapore, because again, when we talk about stocks, and we are stock pickers, we want to focus on companies that are also restructuring despite the pandemic. So I think COVID has done one good thing, which is really enhance innovation and help companies recalibrate their growth and to be able to focus on sectors of new growth. Take, for example, a company like SATS. SATS is basically an airline catering business, but I think through COVID, we have seen SATS actually diversify a lot more into areas that are in non-aviation food. So you have food services, and you have also other areas of growth. And they have also been able to harness their capability to do freight transportation for vaccines, for the healthcare products, and e-commerce. So these are some areas that we think make some of the service stocks interesting, as opposed to taking a view on buying the full recovery for the sector.
I think our discussion on the Singapore's equity market will probably go on and on, but unfortunately we only have about 20 minutes to talk about Singapore's market. So I'll just ask both panelists one last question. Kenneth and Terence, how are you guys positioning your portfolios for investors in 2021? Maybe Terence, you would like to share first?
Well, I love the Singapore market and I love small and mid caps, right? But last year, especially during crisis, I always tell people, you don't have to be too creative. You can just you can just look at the large guys, you can look at the STI components, you don't have to take too much risk. But right now, given that like you're a lot more positive, I'm also like shifting a little bit. I still think that within the big cap space, the properties are worth looking at. They're trading about 50% discount to RNAV, some selected REITs. And then if you want to be a little bit more aggressive, you can play into the Keppel, Sembcorp Marine kind of, the takeover. So Sembcorp Marine, I think, looks interesting to me, though the risk is slightly higher. Reserve, some ammunition, I believe, for the small and mid caps, because I think that they are going to look very, very interesting. And there are very good stories to tell, and many of these guys are trading at very, very palatable